All right, welcome. Thank you for joining me on the program.
Thank you.
Right. The Monetary Policy Committee has once again left the benchmark interest rate at 12%. However, this time the CRR for on private sector deposits has been increased from 12% to 15%. What's your take on that?
Right. I wasn't expecting any tightening. And, by I think a decision of 5-4, they had decided to leave the rate the same. My worry is that the central bank continues to omit discussion of some key aspects of the economy in coming to their decision to continue with policy tightening. I have three variables in mind that I thought that the Monetary Policy Committee did not provide sufficient discussion of. That if they had discussed those variables sufficiently, they would not at this time continue with the policy of tightening.
And what are those variables?
The first is the growth rate of the economy. They did discuss the estimated rate of growth of the economy in the fourth quarter. We're in March. If you are discussing estimates of what happened in the fourth quarter, that is sufficient to make you feel that any decision to tighten should be kept on hold until you have the actual growth figures. That's one. Two, there was no discussion of spending. They did review the contribution of demand to the situation in the international environment, but there was no mention of demand, of domestic demand. We do not know whether demand is weakening or strengthening, although they did report that M2, that's broad money, contracted, and the contracting broad money might be a pointer to a weakening demand. You do not tighten monetary policy in the face of weak demand. The third variable that I thought they should discuss and that they omitted is unemployment. From figures, unemployment figures coming from the Bureau of Statistics suggests that the rate was as high as 23.9% in 2011. The mid-term report of the federal government put it at 27% in 2012. We don't know what unemployment became in 2013. We don't know what it is now. For the central bank to omit a variable as key as unemployment, so if it was 27% in 2012, was it 30% in 2013? Is it above 30% now? And yet, the Monetary Policy Committee of the Central Bank is continuing with monetary policy tightening at 30% unemployment. I think that's a key omission.
Right, we could see that in taking the decision to tighten the monetary policy, there were the committee members, just as you noted, were quite divided, 4-5. Now, if some were of the view that it should be raised, some maintain that it should remain where it is. If you were in their shoes, what would you have done?
If I was in their position, I will look for information about the situation with demand, about the situation with employment, and I would wait until actual growth figures on the economy comes out before I do further tightening. They tightened something. The fact that they didn't tighten the policy rate, is a material. You tighten something. You raise the, rate, the liquidity requirement for private deposits. That's tightening.
Now, what's the implication of this? Now we have the CRR for private sector deposits increased to 15%, and then we also have public sector deposit 75% retained at 75%. Looking at this scenario, what are we likely to see in the economy? What's the implications of this?
Well, to begin with what we have seen from 2009. In 2009, inflation rate was 15%. Unemployment rate was 15%. Since 2010, the central bank embarked on this aggressive policy of tightening monetary policy. Inflation rate has dropped to like 7.5%, and unemployment rate has doubled to 30%. If you continue to tighten without any reference to real economic conditions, you continue to get worsening unemployment rate, contractions in demand, weakening growth. But you say, oh, inflation is, single digit. Inflation is dropping from 8 to 7.5%. Nigerians don't live for inflation. And inflation is not the Nigerian economy. Growth is the economy. Spending is the economy. Employment is the economy. So it's not about 5 people, 4 people like tossing a coin whether to tighten or not to tighten. And it's about all the 9 people in attendance giving concrete information, telling us concrete things about what they think the situation is in the economy and how monetary policy variables are contributing to that.
Well, according to them, of course, their drive is to stabilize monetary policy stability. Monetary stability, we have the...
It's not in threat. Monetary stability is not in threat. They reported, that inflation has fallen further. They reported that broad money contracted. Their target is for a 15% expansion on an annualized basis. It contracted by like 13% on an annualized basis. So there was nothing at risk. There was no need to tighten if you already have such weakness, in broad money.
Now, is it possible to actually have a low interest rate, stable exchange rate, and of course, single-digit inflation rate? Because if I would recall, some time ago, the suspended CBN Governor Lamido Sanusi was of the view that, there was no way he could have achieved single inflation rate, stable exchange rate, and also have a low interest rate. According to him, he's not a magician. So as an economist, is it really possible, or do you agree with him that there's no way we can achieve these 3 things together?
The economy is not just about inflation, interest rate, and exchange rate. The economy is about growth, production. It's about spending by households. Consumption spending is about business spending on investment. It's about employment. So we cannot live our lives, talking endlessly about. So low inflation is a means to an end. Stable exchange rate is a means to an end. And we desire to see, lower interest rates. You are dealing with a regime now where you have real interest rates of nearly 10%. Or, double-digit real interest rates. It's not good for investment. It's not good for spending. It's not good for employment. The real interest rate regime is far too high, and it's going to undermine, more important economic outcomes.
For some time now, we've seen the Naira has been under pressure, and the CBN has been trying its best to actually protect the Naira. Now, what do you think the CBN should do in this regard to really check this pressure?
Well, the key issue is why the Naira is under pressure. The Naira has been coming under pressure not because of any domestic misalignment. The Naira has been coming under pressure because of the policy normalization by the United States. That is, winding down on its asset purchases. And that's not a Nigerian problem. Yeah. That's a global problem. It's having a bigger adverse impact on many other emerging markets. Nigeria is able to weather the storm because Nigeria enjoys favorable commodity prices, in particular favorable oil price. Gives Nigeria the external reserves to absorb the shock. Yeah. Insofar as we are dealing with an and an external problem. And it's a temporary problem, it's not a permanent problem. As long as we have the reserves to absorb the shock, we should continue to use the reserves to absorb the shock, as we have been doing.